Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Levi Strauss Co. annual report. Levi Strauss Co. offers a wide range of products and services across various categories. At the core of their business are apparels for men, women, and children, including jeans, casual and dress pants, activewears, tops, shorts, skirts, dresses, jumpsuits, shirts, sweaters, jackets, and footwear. The company also provides related accessories under its four main brands: Levi's, Levi Strauss Signature, Denizen, and Beyond Yoga. In addition to product offerings, the company has a robust distribution network that includes third-party retailers such as department stores and specialty retailers, e-commerce sites, franchisees, and company-operated stores. This allows customers to purchase products through various channels, including online shopping and in-store purchases at mainline and outlet stores. The company also operates brand-dedicated stores and shop-in-shops within department stores and other retail locations. Overall, Levi Strauss & Co.'s business encompasses a broad spectrum of products and services aimed at meeting the diverse needs of its customers worldwide. Levi Strauss & Co. experienced a notable increase in its stock price, rising 11.79% in the past year due to strong financial performances and strategic initiatives throughout 2025. The company's fourth quarter results for 2024 showed a 12% increase in net revenues, with a record gross margin of 61.3%. This was followed by better-than-expected first-quarter results in 2025, where revenue and profitability exceeded expectations. The company continued to perform well throughout the year, surpassing fiscal second-quarter estimates and raising its full-year revenue and profit outlook. In the third quarter, Levi Strauss & Co. reported better-than-expected results, with revenue growing 7% year-on-year and adjusted EPS exceeding consensus estimates by 11%. The company's strategic transformation, focusing on a direct-to-consumer (DTC) approach, was highlighted as a key driver of growth. The DTC channel grew by 11% in fiscal year 2025, now accounting for approximately half of the company's total business. The core Levi's brand achieved 7% growth in fiscal 2025, strengthening its position as the leading denim brand globally. Additionally, the company demonstrated its commitment to returning capital to shareholders through increased dividends and share repurchases. These consistent positive financial results, coupled with a successful strategic pivot towards a more consumer-focused, DTC-centric lifestyle company, were the primary catalysts for Levi Strauss & Co.'s stock price increase over the past year. Levi Strauss & Co. market capitalization of $8 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Levi Strauss & Co. holds a significant advantage in their industry. Levi Strauss & Co. trades at a higher price-to-earnings ratio of 16 times and a higher price-to-book ratio of 3.7 times relative within the industry. Despite the industry trading at relatively low valuations, the stock commands a premium over its peers. Unless supported by a strong economic moat, the company might not appear to be the most attractive opportunity in the sector and is likely fairly valued at best. The leverage on the balance sheet appears elevated, with liabilities of 69% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The company have a dividend yield of 2.74%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a review of recent financial data. Revenue growth was observed in the U.S., with an increase of $250 million, 4.2%, from 2023 to 2025. Conversely, the wholesale channel experienced a decline in revenue, particularly in the Americas and Asia regions. The direct-to-consumer, DTC, channel played a significant role in driving revenue growth, with increases of $94.7 million in the Americas and $86.6 million in Asia. Segment-wise, the Americas segment saw a revenue growth of $563.7 million, while the Europe segment experienced a decline of $182.8 million. The Asia segment, on the other hand, recorded a significant growth of $650.4 million. Beyond Yoga's net revenues also contributed to the overall revenue growth, increasing by $131.1 million from 2023 to 2025. Total net revenues saw an increase of $2,040.1 million during this period. However, certain factors such as the discontinuation of Denizen brand and the sale of Dockers business may have negatively impacted revenue growth or decline. The net income of the company has shown an increase from 2023 to 2024, with a significant jump in 2025. In 2023, the net income was $249.6 million, which decreased to $210.6 million in 2024. However, in 2025, it surged to $578.1 million. The profit margins of the company have also shown an improvement over the years. The gross profit margin increased from 45.9% in 2023 to 49.2% in 2024, and further to 52.3% in 2025. This indicates that the company has been able to maintain a higher percentage of its revenue as profit. The segment operating income, as a percentage of total net revenues, also shows an improvement, with approximately 19.8% in 2025 compared to previous years. However, it is essential to note that the company's profit margins are affected by various factors such as changes in revenue and expenses, impairment charges, and foreign exchange risk contracts. Overall, the data suggests that the company has experienced a significant improvement in its net income and profit margins over the past few years. This can be attributed to various factors, including increased efficiency, cost-cutting measures, or strategic business decisions. The company's financial performance indicates a consistent generation of positive operating cash flow. According to the provided summaries, the company has been able to generate significant amounts of cash from its operations. In 2025, the company reported $529.6 million in cash provided by operating activities, page 60, which is also reflected in the net cash provided by operating activities for that year, $529.6 million on page 86. Furthermore, another source indicates a higher figure of $1,234 million in operating cash flow for 2025, page 91. However, there are conflicting reports on the company's operating cash flow performance. One page suggests that the company generated positive operating cash flow only in 2024, page 149, which contradicts the other sources indicating a consistent generation of positive operating cash flow from 2024 to 2025. Despite this discrepancy, the majority of the information points towards the company generating positive operating cash flow, particularly in 2025. This suggests that the company's operations are generating sufficient cash to support its financial performance and growth. The company's debt level and interest expenses have undergone significant changes. The total debt level has increased by $125 million since the previous period, with a notable increase of $39.7 million from 2024 to 2025. Interest expense has also seen a substantial rise, increasing by 16.3% from 2024 to 2025, amounting to $48.6 million compared to $41.8 million. The company's reliance on debt has led to an increase in interest expenses, with net cash used for financing activities rising by $80.9 million from 2024 to 2025. Furthermore, the total future debt principal payments have increased from $500 to $550.80, indicating a growing burden of debt repayment. The data suggests that the company's financial situation has become more complex, with multiple instances of changes in debt level and interest expenses reported throughout the summaries. While some figures may vary slightly, the overall trend indicates a significant increase in debt and interest expenses, which warrants careful consideration by stakeholders. The company's outlook and strategy are centered around several key initiatives. Firstly, it is focusing on diversifying its portfolio through investments in new stores, distribution capacity, and technology to accelerate profitable growth. This includes a disciplined approach to expansion, taking into account current macroeconomic conditions. In addition to diversification, the company aims to generate strong cash flow from operating activities and return value to shareholders through share repurchases and dividends. It is also actively managing its foreign exchange risks through forward contracts and has unused availability under its credit facility of $875.4 million at November 30, 2025. The company's investment strategy for pension plans involves investing in a diversified portfolio of domestic and international equity securities, fixed income securities, real estate, and other alternative investments. Furthermore, it is focusing on its core Levi's brands business, which includes Levi's, Levi Strauss Signature, and Denizen brands, although the Denizen brand has been discontinued as part of a strategic decision. Overall, the company's strategy appears to be centered around diversification, cash flow management, risk management, and a focus on its core Levi's brands business. By taking a disciplined approach to expansion and emphasizing preservation of principal and liquidity, the company aims to mitigate investment and credit availability risk while generating strong returns for shareholders. The company has made several significant acquisitions and divestitures over the years to shape its business strategy. In terms of acquisitions, the company has a history of acquiring businesses or partnerships that complement its existing operations or offer growth opportunities. This approach is expected to continue in the future, with additional acquisitions planned. The company may also make strategic investments in businesses or partnerships to further its goals. One notable acquisition was made in 1985 when Levi Strauss Associates Inc. acquired the company. On the other hand, the company has also engaged in divestitures, which involve selling off certain business units or assets. A notable example of this is the sale of the Dockers business. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out a significant portion of its net income as cash dividends. For instance, it declared a cash dividend of $0.14 per share in January 2026 and has paid out substantial amounts in previous years, including $212.9 million in fiscal year 2025 and $198.5 million in fiscal year 2024. In addition to paying dividends, the company has also been actively buying back shares. Its goal is to offset dilution or take advantage of opportunistic buyback opportunities. In recent years, it has repurchased a substantial number of shares, including 1.6 million shares for $30 million in CONE 2025 and 4.8 million shares for $90 million in fiscal 2024. Furthermore, the company accelerated a share repurchase transaction to repurchase $120 million of Class A common stock in 2025. These actions demonstrate the company's commitment to returning value to its shareholders through both dividend payments and share buybacks. There are significant concerns about inventory buildup and supply chain disruptions. One major issue is the potential for excess inventory levels due to inaccurate forecasting of consumer demand, page 19. This can lead to inventory write-downs and sale of excess inventory at discounted prices, resulting in lower-than-planned margins. Supply chain disruptions can be caused by various factors such as foreign currency fluctuations, political instability, changes in trade policies, inflationary pressures, and regulatory restrictions, page 16. Additionally, extreme weather conditions and natural disasters, public health crises and pandemics, local or regional disasters affecting human capital and operations, climate change potentially disrupting shipping channels and raw material availability can also cause supply chain disruptions, page 17. Inventory buildup is also a concern due to the transition from owner-operated facilities to third-party logistics providers, which may lead to shipping delays, order cancellations, and increased costs, page 47. Furthermore, port congestion and inventory delays have impacted the ability to service demand, causing capacity pressures within distribution centers, page 20. The company is also experiencing inventory buildup in various regions, including Americas, Europe, and Asia, page 146. The concerns about inventory buildup and supply chain disruption are further highlighted by the restructuring charges and asset impairments related to Project Fuel, page 65, which may indicate changes in their inventory management and supply chain strategy. Overall, the company faces significant challenges in managing its inventory levels and supply chain operations. Addressing these issues will be crucial for the company's future success. That concludes the financial summary for Levi Strauss Co. Feel free to comment below and I will be happy to answer them when possible.